First, I'll start off with asking Dr. Bivens a question because you've talked a little bit about interest rates and how valuable it has been to the economy for the Fed to lower interest rates. But isn't it true that there comes a point where they can't accomplish that, where the effort to lower interest rates doesn't actually lower interest rates, and we may be even entering that period right now? I mean, there's a lot of monetary inflation right now with QE2, and there are signs that bonds aren't doing as well, and they may be shifting. What happens to those who agree with your policy? What do they do if the more they inflate, the higher the interest rates goes? And in a way, we had that in the 70s as well. Then what do you do? What is the policy that is necessary to counteract that when interest rates are going up when you don't want them to go up?
A couple things. I mean, one, you mentioned the experience of the 70s. I mean, to me, the experience of the 70s, why interest rates were high, was because inflation rates were high. And so my best guess over the next couple of years, and it's a guess based on, you know, a firm historical relationship between how much slack is in the economy and inflation rates, we do not have to worry about spiking inflation in the economy anytime in the next couple of years. So your scenario where the Fed continues to ease, maybe undertakes even another round of quantitative easing, and somehow interest rates on the long term start rising, I'd say they'd need to reassess the policy then. But my read of the evidence so far is that with each announcement of the rounds of quantitative easing, you've seen a robust fall in interest rates across the risk and term structure, which was exactly the target, and it's filtered through to more spending in the economy.
I thank you, and I'd like to get a comment from Dr. Vetter or Dr. DiLorenzo on that subject.
Well, let's first talk about.
Okay, thank you. Sorry, PhDs don't help you operate simple things. The QE2 was announced on November 3rd. It is now February 9th. What has happened to the interest rates on 10-year or 30-year federal government securities in that interim? Well, my read of the evidence, and I just look at the interest rate yesterday versus November 3rd, is that the interest rate on 30-year government bonds has risen somewhere between 65 and 70 basis points. The interest rates on 10-year notes have gone up more than 100 basis points. This is not a move down. It's not even staying still. It's going up. Now, in that period, we're buying, what, $50 billion of bonds a month. We bought several $100 billion. The Fed now owns $1 trillion worth of federal long-term securities, I believe, or close to it, the better part of that. To me, that's just the evidence. And it suggests that your concern, Dr. Paul, is correct, that the increased inflationary expectations have overwhelmed the effects, the immediate effects that the Fed has when it pushes up bond prices when it buys securities. So I think I think your concern is valid.
Yeah, I agree. That's what we're seeing is inflationary expectations driving up those interest rates, and it might not be hyperinflation, but we're beginning to see it. And you see some of the inflation around the world too. A lot of the U.S. dollars that are in circulation end up overseas, and I think there's probably a connection between the high food prices that you're seeing in different places around the world with this inflation. And but that's not the only problem that can be created by the monetary expansion. It's the misallocation of resources. The Fed is creating a different kind of boom with its quantitative easing. And no one can predict what will happen, but in the next couple of years, we could see another bubble, and I think it's likely to be much bigger than the housing bubble was, and then we'll really be in trouble.
I'd like to ask Dr. Bivens first about his statement on page 7. He says, in short, the Fed saw the economic downturn coming before any other major macroeconomic policymaker body. And there have been a lot of others. What do you do with the free market Austrian economists? And there were more than a few. How do you dismiss them so easily? Because they did predict it correctly.
Yeah, I would absolutely not say the Fed was the first to see it coming of any economist. I have colleagues who warned in 2002 that home prices were getting too high. I meant to say they were the first major macroeconomic policymaking institution They acted first. There's three big arms of macroeconomic stabilization, right? There's fiscal policy, Congress, there's monetary policy, the Fed, and there's exchange rate policy controlled by the Treasury. And of those three institutions, the first one to start providing lots of ease to the U.S. economy was the Fed.
My time is about up, but I just want to go on to the next speaker by quoting Bernanke, and this was in the fourth quarter of '07. We may see somewhat better economic conditions during the second half of 2008. This baseline forecast is consistent with our recently released projections, which also see growth picking up. He had no idea that it was coming. I mean, he was so reassuring, and he misled so many people, and I just think there's a lot, and if I had more time, I would get other comments, but maybe later on. But it just seems like the Fed was way behind on this whole issue. I'd hate to think they were they were the first ones to warn us. I think they were the last ones to even recognize what was going on. Okay.